What valuation should you use when pitching angel investors? Imagine standing in front of a room full of potential backers, eager to hear about your startup. The question is, what number should you put on your company? Choosing the right valuation can make or break your funding round. It's a tricky balance because you want to attract investors but also keep enough equity for yourself. When pitching to angel investors, you need to use valuation methods suited for early-stage companies. These startups often don't have big revenues or long operating histories, so traditional valuation tools don't work well. Instead, you relying on approaches that consider qualitative factors and potential. One popular method is called the Berkus Method. It assigns dollar values to 5 key areas: your idea's soundness, whether you have a working prototype, the strength of your management team, your board of directors, and initial sales or product launch. This method is especially good if your startup is pre-revenue because it combines subjective assessments with rough dollar estimates. Another common approach is the Scorecard Method, sometimes called the Bill Payne Method. It starts by looking at what similar startups in your region and industry are valued at before investment. Then, it adjusts that baseline based on your team's strength, market size, product stage, and competitive landscape. This gives a more structured way to justify your valuation and compare your startup to others that have already received funding. The venture capital method is also used, especially when there's some idea of future exit value. It projects how much your company might be worth when you sell or go public. Investors then decide what they're willing to pay today based on the expected return on their investment. This method focuses on potential returns and is useful if you have a clear plan for growth and exit. The Risk Factor Summation method starts with a base valuation and adjusts it up or down depending on specific risks. These risks include technology challenges, market competition, operational hurdles, and other uncertainties. It helps you account for what might go wrong and shows investors you understand your risks. When setting your valuation, consider a few key factors. High-growth markets or large target audiences can push your valuation higher. Unique technology, intellectual property, or first-mover advantages also add value. Even if you don't have much revenue yet, a clear path to making money supports a higher valuation. The quality of your team matters a lot because experienced founders reduce the perceived risk. Angel investors usually want to own between 10 and 30% of your company in exchange for their investment. They also aim for a return of 10 to 30 times their money over 5 to 10 years. Knowing these expectations helps you set a realistic valuation that aligns with investor goals. Regional and industry standards are important too. Valuations differ depending on where you are and what sector you're in. For early-stage startups, pre-money valuations typically range from $1 million to $8 million, depending on the specifics. Your job is to back up your valuation with data, a clear explanation of your strengths and risks, and realistic growth plans. By using these methods and considering these factors, you can arrive at a valuation that makes sense for your startup. Presenting a well-supported number shows investors you understand your business and helps set the stage for a successful funding round.